Welcome, everyone. Thank you for joining us for today's webinar. My name is Beth Cohen-King, and I'm the Marketing Director at Margolis & Bloom. Margolis & Bloom works with its clients to find the best estate planning or elder law solution for each client's unique situation and goals. We bring to this effort 30 years of experience and a commitment to providing the highest level of personalized service. No, the left side. Today we are presenting a primer on Massachusetts estate tax. If you have any questions during the presentation, please type them into the question box in your control panel on the right side of the computer. We're going to have time for questions and answers at the end. So I want to turn the time over to our presenter, Harry Margolis, who's been representing seniors, individuals with special needs and their families since he started Elder Law Services, the predecessor of Margolis & Bloom, in June of 1987. Since then, he and the firm as a whole have helped thousands of clients pay for long-term care, grapple with the incapacity of a family member, and plan for safe and productive futures for their children and grandchildren. So with that, I'll let you take it away, Harry.
Thanks, Beth. Good afternoon, everybody. So now we're going to talk about why, one of the many reasons I'm sure you're delighted to be living in Massachusetts. And the fact is that we're one of the few states now that still has an estate tax, and those I'll discuss somewhat later. We also are tied with Oregon for the lowest threshold for taxation, which at $1 million. But just to give you a little preview of what we'll be doing over the next half hour to 45 minutes is first I'll give you an overview of how the tax works. Then we'll talk about reducing the tax either through gifting or spending, planning for couples, and making larger gifts. And then finally, we'll open up to questions and answers, which you'll be able to type in, and we'll do our best to answer them. And we'll explain that again when we get to that point. So, as I mentioned, the threshold for the estate tax is $1 million. But it's an interesting, the framework of the tax is kind of interesting because if you're over the threshold, they don't just tax the amount above $1 million, they tax you back down to everything above $40,000. So the rates are, it's a graduated tax, and the rates range from 0.8%, so 0.8% down at $40,000, and up to 16% for assets over $10 million. But the way it works out is that you end up with a higher effective rate if you're near the $1 million threshold. So here's a few numbers here. So if you're, now you might say, we'll explain later why if your estate is under $1 million, you still might have to pay an estate tax. So an estate of $400,000 may, in some circumstances, pay $10,000 in estate tax. But where things get interesting is if you have an estate of $1 million, I should probably say $1,001,000 or $1 million, you have a 35% estate tax, and so that's a 3.5% effective rate on your whole estate. But it's a 35% rate on that last dollar, because you have $999,000. There's no tax, and if you have $1,001,000, you have a $35,000 tax. I guess that's far more than a 35% tax rate. Since it's much more than your extra dollar of assets. But then if you have a $1.5 million estate, the tax rate is $70,000, a 4.7% rate on the whole estate, again, even though the marginal rate then is 6 or 7%. $2 million, you have about $100,000. And all these are approximate taxes because a lot goes into this, because there are a lot of potential deductions for gifts to charity, for debts that the estate may owe, for expenses of administering the estate, including executor's fees, things like that. But again, a $2 million estate is you may have $100,000 in taxes, which is actually, when when we get into planning for couples, you'll see that's a key figure. And a $3 million estate would have a tax of about $180,000 for a 6% overall effective rate on the entire estate. So the question is whether, one question is always whether to worry about this, because if you're not going to have that large a tax, do you want to go through take the steps necessary to reduce it or not? And that's up to each person. I guess as beauty is in the eye of the beholder, so is tax planning. So the question is whether you want to do any tax planning, and we'll show you how to do it if you do. So just a little more background though. First is, you may ask, well, why do we? Well, first I should explain that it's a complicated tax structure. So at one point, Massachusetts had its own tax and its own estate tax, and it changed it because what a lot of states were doing was called a pickup tax. So when the federal government had an estate tax, and of course they still do, if your state is over 11.2 million, but that's not too many people these days. They would now going back almost 20 years, they would give you a credit for some of the amount of money that you paid to the state. So if you had a $100,000 Massachusetts estate tax and a $300,000 federal estate tax, then at least some of that $100,000 would be credited towards the federal. So let's say half of it, $50,000, would be credited for the federal. So instead of paying $100 to Massachusetts and $300 to the feds, you would pay $100 to Massachusetts and $250 to the feds. And so what a lot of states said, well, let's make it really easy. Rather than having a separate estate tax structure, we will say that the Massachusetts or the state's estate tax will be whatever the federal credit is. So if the federal credit is $50,000, that's going to be our tax. So in that case, it's basically just taking some of the money that would otherwise go to the federal government. And so that's a pickup tax, and it didn't cost the state anything more than they were already paying, but it has some money going to the states. So Massachusetts eventually adopted that structure. And then shortly after they adopted that structure, during the administration of the second President Bush, they started increasing the thresholds for the federal estate tax, and they phased out the credit. So all of a sudden, Massachusetts was seeing, and a lot of other states were seeing, a reduction in their revenue, even though they hadn't done anything. So they hadn't changed their law, but since their tax was based on the credit, and the credit was disappearing, their taxes were going down, or they could see them going down. So what Massachusetts said was, we will just freeze the credit, in effect. We will say that our tax going forward will be the credit that was in place, the federal credit that was in place back in 2001. So now, when somebody dies, if they have an estate of over $1 million, they have to file a Massachusetts estate tax return. But in order to prepare the Massachusetts estate tax return, they also have to complete a federal estate tax return for 2001. So as every year goes by, this becomes more and more of an anomaly. But that's the process. So if you have an estate over $1 million, you prepare the federal estate tax return for 2001. You figure out what the state estate tax credit would have been back then, and that's the amount your state has to pay to Massachusetts. And we gave you some examples of how much that would be. So that's the structure works, how the structure works. But another important question is, that comes up in a lot of the states, is what about what's in that, what's calculated in that $1 million? And so two things are important. One thing is if you have real estate outside of Massachusetts, you do not include that. And that was a gray area, but it was recently decided, really in a case involving out-of-the-country property, but applies to out-of-state property. So if you have a vacation house in New Hampshire or a condo in Florida, that's not counted. It's not counted in determining whether you're over $1 million or what your estate tax will be. On the other hand, if you if you were a non-Massachusetts resident, say you're a Florida resident but had a vacation house on the Cape, you may be taxed on that. And I'll show you how that works. So let's say you're a non-Massachusetts resident and you pass away and you own that house on the Cape, and let's say your total estate was $1.5 million and the house on the Cape was $500,000. So that's 1/3 of your total estate. So what they do is they basically prorate it. So if they say, well, what would your Massachusetts tax be if you had died in Massachusetts and for a $1.5 million estate, the tax is about $70,000. And then they prorate it, so they divide that in a third. So since the $500,000 house in Massachusetts constituted a third of your estate, you pay a third of the tax. So that works out to $23,000. And that's, and then we have another example, which is you have the same house, but the decedent in this case has an estate of $3 million. So the house in this case is 1/6 of the entire estate. So the tax on a $3 million, Massachusetts tax on a $3 million estate for somebody who died a resident of Massachusetts would have been about $180,000. And in this case, you divide that by 6 and you get $30,000. So the tax is about $30,000. So it's not going to break the bank, but it's something to be aware of. So that's probably not applying to too many people on this call, but again, it's important to be aware of it. So we're going to talk about 3 ways to reduce your Massachusetts estate tax. And the first is by reducing the value of your estate. So if your estate is over $1 million, and if you can get it under $1 million, then it won't be subject to tax. Now, that can be difficult in some cases because you have, especially in Massachusetts, if you own a house in Massachusetts, that might be pushing you pretty close to the $1 million all by yourself, if not over that. But if you're not as close, I mean, if you don't have most of your estate made up of real estate, it may be a little bit easier to spend down to get under $1 million. So you can do this either by spending or by making gifts. You can make gifts of any amount to charity, and you can make gifts to individuals of $15,000 a year without reporting it, having to report that to the IRS. So if you have 3 kids, and if they're married, and you give each of your children $15,000, and you give their spouses $15,000, that's $90,000 a year. If I did my math right, yes. And you can probably pretty quickly get under $1 million that way. So that's one example. And then another example, just give you example of Jane. So we didn't get that new.
No, we did.
Where's that?
Should be there. Go back. No.
How do you go back?
The arrow.
Sorry about that. Thought I had a slide here. I need some technical assistance, which Beth is going to provide.
I hope. Maybe.
There it is.
Oh, it didn't register.
Okay.
Email. Okay.
So we had revised the slide, so I'm going to talk you through it. So Jane, so this is meet Jane. So I will introduce you to Jane. So Jane has an estate of 1.2 million, and this is made up of her home, which has a fair market value of $600,000. She also has savings and investments of $300,000 and an IRA of $300,000. So again, a house worth $600,000, savings of $300,000, an IRA of $300,000. And so if she does nothing and her estate stays at this level, when she passes away, this tax will be about $50,000. And so that's $50,000 on a $1.2 million estate isn't the end of the world, but it's $50,000 her heirs may prefer not to pay. And if she can get her estate under $200,000, or down by $200,000, so it's down under $1 million, she will save her heirs $50,000. So even though $50,000 isn't a huge percentage on her whole estate, it is a pretty large percentage of that $200,000 that she's over the limit. So it's a quarter of that. So that's a pretty high marginal rate.
No,
so
left, right?
there we go. So here's a few possibilities. Now she can transfer her children in interest in her house, and if she does this in $15,000 increments, then she will get under she won't have to report it, so it won't be a reportable gift, and we'll talk later about why that's an issue. And that's in that way she'll still have her cash to live on. So that's the advantage of that. The disadvantage of transferring the house in these portions, which you can do through a nominee realty trust, is that for the portion that she transfers to her children, they won't get a step up in basis at her death. So if she bought the house for $200,000 and is now worth $600,000, and they sell it without having, if they inherit it and they sell it, they won't have to pay any capital gains taxes. But if they own part of it as a gift, for that portion, they'll have to pay a capital gains tax. So there's kind of a pro and a con. Now, if it's a condo that she just bought for $600,000 and there's no appreciation, then we don't have that issue. She could also make gifts of her $300,000 in cash and savings and investments. Again, in terms of the investments, she may have the same capital gains issue if her investments are in appreciated stock and she has to sell them to make the gifts. She will also have to pay the tax herself, and again, she'll have less cash in her own hands to pay for whatever her needs may be in the future. She could also accelerate her IRA distributions so that she has more money to make gifts with. But again, the problem with that is she'll have to pay taxes on that. So, are there any other solutions? So one idea is she could take out a loan on her house. So if she borrowed money on her house and then distributed the proceeds in gifts of $15,000 each to her children, then there's no adverse capital gains issues because she's not giving them a piece of the house, she's just giving them the cash. So that would solve that problem. And then so let's say she borrows $200,000 on the house, ultimately gives this amount to her children, gets herself her estate under $1 million, and then when she passes away, her estate still may add up to, she still has the $600,000 house, and she still has the savings and investments, and she still has the IRA, to the extent she hasn't taken out over the intervening years. So her estate may still show a gross amount of $1.2 million, but because she would then have this debt of $200,000 on the house, that gets subtracted out and gets her under $1 million. So there's the costs. So say this solves the capital gains tax problem and the estate tax problem, but of course during the time that this is going on, she's paying interest in the loan, which may or may not be worth it. So that's the main planning techniques for a single person is really gifting and spending, and sometimes being creative in order to to make the gifts, even though you have a large capital possession like a house that's not liquid, and using loans can help in that case. It's easier for couples to plan. So, and the main reason, well, there are two things. One is there's no tax for anything you give to your spouse. So there's only a tax when the second spouse passes away. So that's the first thing to understand. But the main issue is, since each spouse can give away $1 million tax-free, you don't want to lose the $1 million of the first spouse to pass away. So together they can give away $2 million tax-free. But if you do no planning, say you have an estate of $2 million, if you do no planning and the surviving spouse has a $2 million estate, then when he or she passes away, there could be a $100,000 tax. And so one way to get both is for the first spouse to die, or for each spouse to give their $1 million. First of all, you have to split the assets between them, and then the first spouse says, everything I own up to $1 million goes to my children. So it doesn't go to the first spouse who passes away. And this effectively protects that first $1 million. And then when the second spouse passes away, if their estate's under $1 million, there's no tax. The big issue there is, are we leaving the surviving spouse enough funds and to live on, number one? And you may say, okay, well, we'll give the house to the kids and leave the cash to give the cash and perhaps an IRA and things like that and retirement plans to the surviving spouse because the house is not liquid. Of course, now the house belongs to the kids, and you got to trust them not to kick out the surviving spouse. So that's also an issue. So this is all under the rubric of don't go overboard. So it's great to save in taxes, and you should do your planning to save in taxes, but don't do so to the detriment of your living. So take care of yourselves first. So let's go back to the initial situation where there has been no planning done. The clients have $2 million, one spouse dies, and everything is going to the surviving spouse. Well, it's often possible to do the planning after the first spouse has died through disclaimers. So if the surviving spouse is inheriting money, either through a will, through joint accounts, from beneficiary designations, he or she can say, I don't want to receive everything, and file what's called a disclaimer. And you have to do that within 9 months of the date of death of the first spouse. And once you file the disclaimer, that property will pass as if there were no surviving spouse. So if it would go to the kids in that case, then it would go directly to the kids. Again, you have all the same issues about whether the surviving spouse will have enough money, but he or she can make that determination when the time comes. So this is just something else to keep in mind when no planning has been done. We always say about planning, it's never too early to plan. You should always get your plan in place, but it's also never too late. So there's usually things we can do. But what most people do who do plan ahead is create a trust for the benefit of the surviving spouse. So rather than have everything go to the children, or having $1 million go to the children in order to use that, in effect, a credit that the first spouse has to give away tax-free, it's possible to have $1 million go into trust for the surviving spouse, be available for his or her needs, but not be in the surviving spouse's estate for tax purposes. And it also makes it easier to kind of do the calculations after death, because we don't know. Someone might have $1.2 million. the trusts are written so that if 1.2 million goes into the trust for the surviving spouse, then it's written so that the funds can be divided into two shares, $1 million not in the surviving spouse's estate, $200,000 is treated for tax purposes as going to the surviving spouse, and there's no tax when the first spouse dies. And whenever you do this, the idea is not to spend the money in the trust if possible, because if that's invested and if it grows at 5% a year over 10 years on average, and now it's $1.5 million when the second spouse passes away, you still won't have any tax on it ever. So that's in effect a way to, in effect, shelter more money, and the money that the surviving spouse has in his or her own name would be spent down over that time and either reduce or eliminate his or her tax. So let's talk, just to make this more concrete, let's say a couple has $1.8 million, and if everything, and we're going to assume that nothing changes, so that there's $1.8 million when the first spouse passes away and $1.8 million when the second spouse passes away. And when the second spouse passes away, the tax will be about $90,000. So if instead the $900,000, the amount the estate was split $900,000 each, and $900,000 that belonged to the first spouse to die went into trust or outright to their kids, and the surviving spouse had $900,000, there'd be no tax. Oh, I guess we already have that. So that's basically the idea: is put it either transfer it outright or put it into trust for the surviving spouse, and the trust are usually better because, again, it's available if the surviving spouse needs it. So now we're going to talk about an issue that's more complicated. I alluded earlier to the issue of a couple of things. One, you can make gifts of $15,000 to any individual per year without having to file a gift tax return, and that there are situations where your estate may be under $1 million and you may still have to pay an estate tax. So, as we discussed earlier, currently there's no federal estate tax if your estate's under 11.2 million, and if you're a couple, you can avoid, a married couple, you can avoid taxes on 22.4 million. And those are state taxes, but the same rules apply to gift taxes. So you can make accumulated taxable gifts of $11.2 million without paying any gift tax. It just uses some of the $11.2 million uses up some of the $11.2 million you give away tax-free at death. So if you, just make it easy, if you give someone $215,000 this year, you're supposed to file a gift tax return, and you will have used up $200,000 of your unified federal estate and gift tax credit. So then you've made this $200,000 taxable gift, and then you can only give away $11 million at death without paying an estate tax. So that probably doesn't apply to anybody on this phone call. Don't have to worry about it. So people are always worried about this $15,000 limit on gifts, and I think it's probably good to use that as an excuse not to give anyone larger gifts. But the reality is, if you make a larger gift to an individual during a year, you're supposed to file a gift tax return. But if you don't file the gift tax return, no one's going to come after you for not doing that. However, here's where it comes in for Massachusetts estate taxes. So for Massachusetts estate taxes, if you, in determining whether you are over the $1 million threshold, you are supposed to factor in your taxable gifts. So if you had a $1.2 million estate, going back to Jane in an earlier example, and the tax, if you make no changes, is about $50,000. If she's able to lower her estate to $999,000, then say through $15,000 annual gifts to her children, she pays no estate tax. However, let's say she doesn't think about this until she's dying, unfortunately, and she says, okay, I want to get under $1 million, and she makes gifts. She gives away $200,000, or let's say $215,000 to her daughter today, and she passes away soon afterwards. She's lowered her estate under $1 million, but because the $200,000 gets added back in for determining whether she has a taxable estate, she's still going to have her estate will still have a $33,000 tax, more or less, and that's because of this tax on estates that are even under $1 million. And of course, you always have to consider, whenever you make any gifts, the effect on capital gains taxes as well. So here are a few examples. So if you have let's say, assume we have a $1.5 million estate, the tax on that is about $64,000. If you make taxable gifts of so what happens if you make taxable gifts is you get taxed on what's left. So if you make a taxable gifts of $300,000, which still keeps you over $1 million because you got 1.2, your tax will be about $50,000. So you save about $14,000. If you make taxable gifts of $500,000, then you've lowered your estate to $1 million, and as we saw in the prior example, the tax is about $33,000. And if you give away $1 million, if you're able to do that without having a lot of capital gains issues you don't want, then you have lowered your estate to about $500,000, and the tax is $10,000. So in that case, you saved over $50,000 in taxes. So, as I said earlier, it's never too late, but it's not as good as this kind of deathbed planning. It's not as effective as planning during life when you have a little more time to really, in effect, do it the right way. But it's not totally ineffective. So, as you can see, it can get somewhat complicated. There's an interplay between estate taxes, gifting rules, income taxes, and capital gains tax rules. So everybody should do their planning, but do it with professionals, people who work in this area, accountants or lawyers or both. And I had one question prior to doing this talk, which was, why do we have an estate tax in Massachusetts when most of the rest of the country has gotten rid of it? And why do we have a threshold that's at $1 million when most of the states that do have an estate tax are so much higher? As I said earlier, we're tied with Oregon for the lowest threshold. And it's encouraging people, to, at least to some extent, to move to Florida or elsewhere, or else if they already spend time in those states, to try to establish their residency in those states, spending at least 6 months there and voting there and doing all the other things you need to do to establish residency, which may be a topic for another webinar in the future. So why are we doing this in those cases? And here's the answer. The answer is we need the money. The state needs the money. So the estate tax still brings in quite a bit of money, over $300 to $400 million a year. And while it's a relatively small amount compared to all the tax revenue earned by the state, which is now up to about $26 billion. So these are just different years. The amount of tax revenue, the amount of state tax collected, and the percentage. It's not the lion's share of the revenue coming to the state, but it's over 1%. And and this is actually understates the revenue, so it's probably, you do it as a percentage, to be less than that, because this is just the tax revenue. I think our budget this year, I heard on the radio this morning, is over $40 billion. So as a percentage of all state spending, the estate tax is probably closer to 0.5%, but it is real money, and it's real money the state needs, and unless it can pick it up from other sources, and or find a way to cut the budget, and of course that's always an issue with people fighting about that. So it's a public policy issue, and which we can leave it to our legislators to debate. So we will answer questions right now in a moment, in which you can type them in. But I'm always ready to answer questions. So I have a website called askharry.info. You can go there. I have a lot of information about estate planning there. And if you have if you don't find your answers there, post your question, and I'll do my best to answer it. We have a legal guide about Massachusetts, about everything we've just been talking about. And how do you download that?
So there's two ways to do it. It is available in the control panel. If you go into, let's see here, handouts, so you can download it right from there. If you can't figure that out, that's okay. You can go onto our website, into resources, and then you'll see legal guides, and you just type in your information, and you can directly download it from there as well.
And then we are recording this online, so if you want to hear it again, hear my dulcet tones again, you can always listen to it again, or send other people to it if you think it would be interesting to them.
Yeah, we'll definitely have it available within the next week, and we post it on YouTube, and I send out links to everybody in email, so just look out for that in your email, and it'll be on our website as well.
Okay. Now it looks like we have some questions. It's a little hard to read on this device here. Oh, we have a number of questions.
Wow. Okay.
Okay, we'll get it. We'll do as many as we can in the next 7 minutes, and then we'll try to answer the others perhaps on askharry.info.
Okay. Let's see here. Does cash or other assets with a named beneficiary become exempt from estate tax? Would not be counted as a taxable amount?
No, those are, so that's a distinction probably I should have clarified in saying what's in the $1 million and what's counted against that for your estate. And it's basically everything. So there's a huge distinction between your probate estate and your taxable estate. So your probate estate is only things in your name that would pass under your will. Things such as accounts with a beneficiary designation, so life insurance, investment accounts, even bank accounts or retirement accounts don't go through probate, and money in trust doesn't go through probate, but it's all subject to estate taxes.
Okay. Is there any max limit on deathbed gifts to get excess over $1 million out of Mass estate?
We discussed that,
Yeah.
so I think that's got it covered.
All right. If as part of planning deed, remainder interest to kids and retain a life estate, will this result in a taxable gift up to the value of the remainder interest?
Yes and no. Okay, so that's a somewhat convoluted picture. So if you create a life estate, you've given a real interest in real estate to your children, assuming you've given them the remainder interest, and that is a taxable gift based on the value of the property at that time and your age at that time. However, it does not, as I said, it's complicated. So it's a taxable gift, and if you sell the house, a portion of the proceeds go to your children because they already have an interest in the house. But under the Internal Revenue Code, the entire value of the house is, if you assume you don't sell it, the entire value of the house is in your estate for tax purposes. So you're technically supposed to file a gift tax return, but it doesn't really come into play in any of this tax planning. What we do for on our deeds when we create life estates is give the remainder interest, but also include in the deed what's called a power of appointment. So I give the house to my children, retaining my right to live and use it for the rest of my life, and retaining also the right through my will to redirect the house to other people. So there are two reasons we do that. One, or at least two. One is then it's not a completed gift to the kids. So even though the requirement to file a gift tax return is probably more technical than real, we'd rather avoid it entirely. So this avoids that. But second, it gives me more control when I've done this, because if I'm not so happy with what my kids are doing, I can still disinherit them. Even though I've created the life estate, I can execute a new deed, a new will, and redetermine who receives the house, and then things happen. So the child who you were going to give the house to might not be a bad kid, and you might not be having trouble with them, but they may be having trouble. So they may be facing bankruptcy or divorce, or they may pass away before you, and you may not want the house to, in that case, to go to their estate. You may want it to go elsewhere. So these are all reasons to retain this power of appointment.
Does the 1 million mass
exempt
trust disappear if you make 1 million in lifetime taxable gifts?
No. So if you've given away $1 million, but your state still says, trying to think this through, but if your state still says the first $1 million goes into trust, then yeah, I can't see how it would affect that anyway. So I'm thinking out loud here a bit. So you made taxable gifts. Interesting. I'd say the answer is no, because usually these trusts are written without that in mind. I mean, I suppose you could write it, but again, so that gets very complicated, because the taxable gifts in terms of the actual tax is a federal issue, and for Massachusetts it's only a threshold issue, and it's not a threshold that affects your spouse. So I'd say the answer is no.
Okay. Does or is it recommended that an attorney complete the state tax form, or can this be done by experienced tax professional or an accountant?
So I think either can do it, either an attorney or an accountant. If you are hiring the attorney anyway for probate purposes, then it probably makes sense to have the attorney do it. If you've been able to avoid probate, so there's really no issue there, then you could have either the attorney or the accountant do it.
Okay. We have a disclaimer clause in wills. Should we remove designation from our accounts? What about IRAs?
So I can't really answer that question in the abstract. So I'd have to, an attorney would have to look at everything to see. Partly it depends what your wills or trusts say, and then in terms of IRAs, if it gets more complicated, IRAs can go into trust and be sheltered for tax purposes, but then the trust has to have certain language in order to hold the IRAs and allow them to be the minimum distributions to be based on the surviving spouse's life expectancy. If they don't have the right language, it's possible that if you have an IRA going to a trust, it will have to be paid or withdrawn within 5 years, accelerating the taxes on the IRA.
Okay, there are a lot more, and so I'll make sure that Harry gets all of these so he can answer them for you more directly, but that is all the time that we have for right now. So thank you, everyone. I hope you enjoyed it. I know there was a lot of dense information in there, but hopefully it was valuable and useful. And please see our contact information if you need additional follow-up, and I hope you have a great rest of the day.
Yeah, thank you all. And also add, if you want to send us an email at firm@margolis.com about any questions you have, any suggestions you have for other webinars, or any suggestions you have for improving this webinar. Let us know. Take care. Enjoy the rest of the beautiful day out there.
Thanks a lot.